Imagine waking up on the first of the month and your brokerage account just received $4,000 without you doing a single thing. No alarm clock, no client call, no boss. The money just showed up because you made one decision years earlier that most people scrolled right past. That decision is SHD, and the starting point is $200 a month. I know how that sounds. $200 a month turning into $4,000 a month in passive income feels like something you'd see on a late-night infomercial. But this isn't a get-rich-quick pitch. It's compounding math, dividend growth history, and a fund that has quietly increased its payout every single year for 14 consecutive years. We're going to walk through every number. No fluff, no rounding things in your favor. Just the real path from where most people are right now to a portfolio that pays them like a part-time job. Let's start with what SHD actually is, because a lot of people throw the ticker around without really understanding what's underneath it. SCHD stands for the Schwab U.S. Dividend Equity ETF. It launched in October 2011 and tracks the Dow Jones U.S. Dividend 100 Index. That index doesn't just grab any stock that pays a dividend, it screens every single holding for four things: at least 10 years of continuous dividend payments, strong cash flow relative to total debt, return on equity, and dividend growth rate. You have to earn your spot in SHD. Most companies can't. The result is a fund with an expense ratio of just 0.06%. That's 6 cents for every $100 you invest, and $86.87 billion in assets under management. It currently yields around 3.4 to 3.5%, with the most recent quarterly dividend coming in at $0.2569 per share. That works out to roughly $1.05 to $1.06 per share annually. Not flashy. But that's not the point. The point is what that dividend does over time. Here's the number that stops most people cold. Since inception in 2011, SHE has delivered a cumulative total return of 481%. The 10-year share price growth rate sits at approximately 8.65% compounded annually. The 5-year annualized total return lands at 8.7%, and the dividend itself, this is where it gets interesting, has grown at a 10-year compounded annual growth rate of 10.72%. The dividend hasn't just kept pace with inflation, it has obliterated it. Back in 2012, SHE paid out about 27 cents per share for the entire year. In 2025, that number hit $1.0476 per share, nearly 4 times the income from the same share, purchased once and never touched. That's not an accident. That's the screening criteria doing exactly what it was designed to do. Now let's build the actual math on the $200 to $4,000 roadmap, because most videos go vague right here, and I'm not going to do that to you. To generate $4,000 a month in passive income, you need $48,000 a year in dividends. At SHED's current yield of roughly 3.5%, that means you need a portfolio worth approximately $1,372,000. That's the target. Write it down. Now, how do you get there from $200 a month? SCHD's historical total return, price appreciation plus reinvested dividends, averages right around 10 to 11% per year. Run that through a compound interest model with $200 monthly contributions and a modest starting balance, and you hit that $1.37 million mark in roughly 30 to 32 years. For a 25-year-old starting today, that's financial independence at 55 to 57. For a 30-year-old, it's still before traditional retirement age, and that is the boring conservative version of this story. Motley Fool ran the numbers independently in January 2025 and confirmed that $200 a month, invested consistently in SHD, builds approximately $25,000 in annual dividend income over the long run. That's $2,083 a month. Still life-changing for most people, without even needing to reach the full $1.37 million mark. The mechanism that makes all of this work is DRIP, Dividend Reinvestment Plan. Every quarter, instead of pulling your dividend as cash, you put it straight back into more shares. More shares generate more dividends. Those dividends buy even more shares. Not a metaphor. Pure arithmetic that compounds faster than almost anything else available to a regular investor. Here's a concrete example. Take a $10,000 starting investment in SCHD. Assume a 3.5% yield and 10% average annual total return, both consistent with SCHD's historical performance. After 20 years without reinvesting dividends, that $10,000 grows to roughly $52,040. Solid. But run the same scenario with DRIP turned on, every dividend automatically reinvested, and after 20 years you have $94,712. An 82% difference. Same fund, same starting amount, same time period. The only variable is whether you hit reinvest or not. And here's the moment most people never talk about: the tipping point. There is a specific year in every long-term SCHD investor's timeline when the quarterly dividend check actually exceeds their $200 monthly contribution. The fund starts feeding itself. You're no longer the primary engine of growth, the portfolio is. From that point forward, the snowball doesn't need you to push it anymore. That is the actual goal. But before we go further, let's address the elephant in the room. You might be thinking, where does $200 a month even come from? The average American spends less than $200 a month on subscriptions they barely open. Streaming services, apps, gym memberships that haven't been touched since February. That money is already leaving your account. It's just not going anywhere useful. Redirecting it, or even half of it, into SCHD shifts the entire trajectory of your financial life. Not about sacrifice, about redirection. Now, March 2026 brought something that most SCHD investors either ignored or panicked about. The fund's annual reconstitution, its scheduled rebalancing, dropped 22 holdings, including Cisco and AbbVie. Big names, both of them. Cisco represented about $3.6 billion in weight. AbbVie, roughly $3.2 billion, gone. In their place, Blackstone, Ares Management, Accenture, Abbott, Procter & Gamble, Qualcomm, and United Health Group. That last one is worth pausing on. United Health Group entered 2026 down 48% from its highs. The stock had been crushed by a combination of legal scrutiny, operational setbacks, and sentiment. No active fund manager in their right mind was buying United Health at that moment. The headlines were brutal, but SCHD's rules-based algorithm doesn't read headlines. It screens for dividend payment history, cash flow quality, return on equity, and dividend growth rate. United Health passed those screens, and the algorithm bought it at a 48% discount. A passive rules-based strategy does what humans almost never can. It buys quality when the crowd is panicking and selling. Not because it's brave, because it has no emotions. That reconstitution is not a flaw in the fund. It is exactly the system working the way it was built to work. Now let's put SCHD in context by comparing it to the two ETFs that come up most often as alternatives. First, VYM, the Vanguard High Dividend Yield ETF. VYM currently yields around 2.26% with an expense ratio of 0.04%. It holds 563 stocks, making it significantly less selective than SCHD. You get broader exposure, but you give up the quality screening that drives SCHD's dividend growth. VYM's yield is lower, and its dividend growth rate historically trails SCHD's. For pure diversification, it has its place. As a dividend growth engine, SCHD has the edge. Second, JP Morgan Equity Premium Income ETF is yielding around 8% right now with monthly distributions. Sounds like the better deal on the surface. More than double SCHD's yield, paid every month. Here's the problem. JP generates that yield through an options overlay strategy. It sells covered calls on its equity portfolio to produce premium income. In a bull market, which is historically the default mode for U.S. equities, that options strategy caps your upside. You miss the full appreciation because you've sold away the top of those gains. JP also carries real NAV decay risk, meaning the fund's underlying share value can erode over time in ways that aren't immediately obvious when you're watching the income hit monthly. SCHD doesn't do any of that. It owns the companies. It collects the dividends they pay. It passes them to you. The income grows because the companies grow their payouts. No derivatives overlay. No complexity. No hidden ceiling on your returns. For a long-term compounder focused on building actual wealth, SHD wins that comparison. JEPI has a legitimate use case for retirees who need monthly cash flow right now. For everyone else building toward $4,000 a month, SHD's total return profile is more powerful. One more concept that deserves its own moment: yield on cost. One of the most underappreciated ideas in dividend investing, and it completely changes how you feel about buying SHD today. Consider someone who bought SHD back in 2012 at approximately $28 per share. At the time, the dividend was modest. Nothing dramatic. Fast forward to today, and that same share is paying $1.05 per share annually. On their original $28 cost basis, that's a yield on cost approaching 3.75%, and it keeps climbing. They haven't bought another share. They haven't done anything. The dividend growth stacked that income on a cost basis locked in forever. When you buy SHD today at its current price and current yield of 3.5%, you start your own yield on cost clock. If SHD grows its dividend at even half its 10-year average, call it 5% annually, your yield on cost 15 years from now will be close to 7.3% on today's dollars. Not 3.5%, 7.3%. On top of the fact that your share price will almost certainly be significantly higher. Dividend growth investing rewards patience in a way that almost no other strategy does. You are not just buying current income. You are buying a growing income stream that compounds on your original price every single year. Let's zoom out and make sure the full picture is clear. SCHD has $86.87 billion in assets, 0.06% in fees, 14 consecutive years of dividend increases, a 10-year dividend CAGR of 10.72%, and a total return track record that puts it among the best-performing dividend ETFs in existence. The 2026 reconstitution just added high-quality names at discounted prices. The math on $200 a month over 30 years leads to a portfolio generating six figures in annual dividend income. Not a complicated strategy, a patient one. And patience, as it turns out, is the rarest skill in investing. Most people won't do this. Not because they can't afford $200 a month. Not because the math is hard. But because 30 years feels like a long time when you're staring at it from the starting line. The people who do it, who automate the $200, turn on drip, ignore the reconstitution noise, and keep buying, those are the people who eventually stop working because they have to and start working because they want to. $4,000 a month shows up in their account every single month while they sleep. So here's what I want you to think about. What is the one financial habit you know you should have started 2 years ago but still haven't? Because whatever that answer is, that gap between knowing and doing, that is the actual thing standing between you and the money. Not the market, not the economy, not the interest rates. Drop your answer in the comments. I read every single one. If this laid out something useful for you, hit the like button. It takes 2 seconds and it genuinely helps this channel reach more people who need to hear this. Share it with one person in your life who's been asking about dividend investing but doesn't know where to start. SHD is the answer they've been looking for. And subscribe if you aren't already, because next week we're going into something that will completely change how you think about the order in which you invest your money. Most people are doing it backwards, and it's costing them years. The money is patient. The question is whether you are.